It's almost time for the Federal Reserve's May policy meeting. The announcement itself is expected to be pretty uneventful, with another rate hike of 25 basis points, 0.25%, being expected, which would be in line with the past few hikes and bring rates up to 5.25%. And since the Fed doesn't really like to surprise the markets that often, at this point we can safely say a hike of 25 seems to be pretty much locked in. However, this is where rates start to get a bit more interesting. We've been hearing from Fed officials over the past several months about where they expect peak rates to be, and we're starting to get quite close to those estimates. This may mean that a pause is coming quite soon. Like take James Bullard for example. He's been one of the most hawkish members on the FOMC over the past year, meaning he typically favours higher rates, but his estimate for peak rates, based on his recent speeches, is around 5.6%. So if the Fed does raise rates to 5.25% at this meeting, based on Bullard's opinion at least, that could suggest there's only a further 2 more rate hikes of 25 basis points each in the upcoming meetings, which bring peak rates to 5.75%. Now, that doesn't mean Bullard represents the overall view of the FOMC, and he's not actually a voting member this year anyway, but this is a key point to listen for in the press conference with Jerome Powell following the FOMC meeting. So we want to pick up on signs of where peak rates are likely to be and how long it may take to get there. With this in mind, there are a few important points that Powell is likely to talk about that we want to pay attention to. The first is obviously inflation. Over the past year, headline inflation, which includes the more volatile food and energy prices, has been a key focus since energy prices have been one of the main drivers. However, the readings are going to start seeing that big spike in energy prices from last year fall out of the data, since they measure from the same month 1 year ago, so that means that headline data should appear to be continuing to slow. So that's a good thing, right? Well, sort of. You see, in recent interviews, Fed officials have been highlighting core data instead, which excludes the more volatile items like energy and food. This has been cited as being a much better indicator for more persistent inflationary pressures, and this gauge has actually remained relatively high, as opposed to headline, which is high but declining from its peak. So that's bad news for the Fed, as it could be interpreted as inflation becoming more widespread throughout the economy and would suggest that rates need to continue moving higher, or at least remain high for a longer period of time, since there's a lag before higher rates fully have their desired effect, if at all. Now, earlier this week, I was talking to Andy Krieger, the legendary trader, about his views on this situation, and here's what he had to say about it.
I think the market, big picture, very vulnerable. I think the market is overestimating the power of the Fed to control inflation. Higher interest rates don't stop inflation. Reduction in money supply will stop inflation over time, and we haven't had that. And money supply meaning the Fed's balance sheet in particular. Fed's balance sheet historically been 5 to 10% of GDP, and now it's 37%, which is, we're talking almost Bank of Japan type levels, which we think are insane. So Fed hasn't done its job here. Look, we have the Fed meeting on Wednesday, and everyone's going to get all excited either way. They do 25 points or they don't. And frankly, in the big picture, it doesn't make any difference. It really doesn't. It's irrelevant. Yeah, you know, what is the Fed fund? It's the rate that the Fed's paying the banks on their balance sheet, you know, on their deposits there with the Fed. I think much more interestingly, we'll start to see some more earnings come out. It's been very skewed. Obviously, many of the big companies have fared well. They had surprisingly good earnings. A lot of companies have had terrible earnings. S&P is dominated by 6 companies now, so there's a big skew there. What I'd like to see, if I'm going to lay out a perfect scenario for a trade, let them raise 25 points. Let the market rally. Oh, that's the last Fed hike for the year. The cycle is done, and then we take the stocks up through the recent highs of 4,200, the S&Ps, and so on. And then they're going to go, why are we buying stocks on this? What's so good here? Because interest rates aren't going up anymore. I mean, I think I'd like to sell when you have some kind of weird euphoria based on nothing. You know, I'd also would love to sell when we get some really good news and the market can't go up.
Now, as some of you already know, we recently launched a collaboration project with Andy, which I'm really excited about. We've been working on it for a while, and it gives you the opportunity to learn directly from him. If you're interested, check out the link in the description box. It's free to sign up, and it's a pretty unique opportunity to get the chance to learn from one of the most well-known traders of all time. And of course, if you want to hear more of his views on the markets in these sorts of videos, just hit the like button to let me know, and we'll bring you more of that. But what else are we seeing in the economy right now? Well, there have been some early signs that it could be beginning to slow. The economy only grew at 1.1% in Q1, although unemployment has remained strong so far. There's also the banking crisis situation, which is still ongoing, although it doesn't appear to be a systemic risk right now. But if the economy slows, that could help to ease these inflationary pressures, since it typically results in lower demand. And if banks tighten their lending requirements, that has a similar effect to hiking rates, which may suggest that rates won't need to go as high as previously expected. Echoes of the credit crunch buzzword we kept hearing non-stop back in 2008. All of these things are likely to be talking points in the next FOMC meeting, and will be some of the factors that will determine whether or not the Fed continues hiking rates or decides to pause in one of the upcoming meetings. But I want to know what you think as well, so let me know your thoughts down in the comment section below. How far do you think rates will go this year, and what markets are you keeping an eye on as a result of that? Do you think we might see some instability in equities coming up? Leave a comment and share your thoughts, and thanks for watching.